Okay, welcome to the third video of Chapter 7. We're going to be covering the last learning objective, and that learning objective is 7.5, Margin of Safety and Operating Leverage. Just a little word about this. So we've been studying the contribution margin ratio, contribution margin method, cost, volume, profit, and this is another kind of additional way of using that information to find out some information about your business. Margin of safety is, well, we've been looking at break even, and sometimes we try and figure out, well, how much will we need to get to target profit. Well, the difference between those two is there's a buffer, what we would call the margin of safety. In other words, if we know what our break even is and we have a target, but what happens if we don't reach our target? How much, what's that buffer that we can maybe not make our target? Operating leverage is it's a little bit more complex of a number in that it involves kind of the interplay of your contribution margin and your variable costs, your fixed costs with your operating income. In other words, it will tell you a little bit about whether the company has higher fixed cost or higher variable cost and how that works with the operating income. And we'll see a little bit of an example. We can also use that number to a few extra calculations. So looking at this first bit here, we're going to cover kind of a very similar problem as we've been using before, in that we have this dinner cruise and we're selling tickets to guests for $50 a ticket, and the same scenario that we had for a number of other problems. So we're going to go over question number 13 focuses on margin of safety. Question number 14 focuses on operating leverage. And then the other two are kind of a mixture. So when we're talking about margin of safety in units, well, we can see that this is our break-even units and this is our target units. So just without even doing any other calculation, if I asked you what the buffer was or what the margin of safety was, you could just say, oh, well, I'm planning on selling 1,500 more tickets than I need to break even, and that's the basis. That's kind of the basic idea of this. So we would say 12,000 is our target number of tickets or units. That could be a manufacturing goal. This is 10,500, so the margin of safety would be 1,500. Now I could turn around right away and say, what is the next question is, what's the margin of safety in dollars? Well, I could just turn around and multiply that by $50 because that's what our tickets per guest is, right? But because they want us to figure out the third thing, which is what is the ratio, this is actually the margin of safety ratio. We're going to go ahead and figure it out maybe a little bit longer way, but just realize you could multiply these two and get the same number. So if we said, well, what is our total sales revenue for our target? So that would be 50 times 600. Sorry, I'm getting ahead. I'm calculating it in my head before I write all the things down. $50 times 12,000 tickets. Well, that's 600,000. Right, so we would say that the dollar amount for the number of target tickets is 600,000, and for the break even, I think it's 10,500, and that comes out to 525,000. And so the margin of safety is 75,000, and as you see, you could have gotten that number here. But you would have needed to calculate to get the margin of safety as a percentage of sales. So here, this 75,000 carries down. This is our margin of safety in dollars. And our total sales is 600,000. And so that's a margin of safety ratio there of 12.5. It doesn't like dots or commas. Okay. I've gotten it to stop jumping around, though, a little bit less. The next question, like I said, the first one was on margin of safety. The second one is on leverage. So whether or not leverage is understandable concept, or at least let's see how the basics of how to calculate it. So the primary calculation for operating leverage is going to be take the total contribution margin divided by the operating income, and that's your operating leverage. So you can see there's a few things that we need to figure out. Well, what is our per unit? What is our unit contribution margin? Well, we have the information here. It's 50 minus 30 equals 20. And if we multiply that 20 by the number of target tickets, that's going to give us a total amount of $240,000 in total contribution margin. Remember, of course, this is just for the 12,000 ticket level. Now, what is operating income? Well, remember our contribution margin income statement is sales minus variable costs equals contribution margin minus fixed costs equals our operating income. Well, we don't necessarily have these numbers, but we did figure out contribution margin. That's 240,000. So it's almost as if we don't need to know this. We already have the resulting number. And we do have fixed costs, 210,000. So our operating income here is 30,000. So when we divide those out, it comes to an operating leverage of 8. So imagine if our fixed costs were a lot less. Let's say our fixed costs were 120,000. And therefore our operating income would be 120,000. And then that you would say total CM divided by 120,000 of operating income would be an operating leverage of 2. So you can see a lower operating leverage means it could mean a couple of things. Either you have a whole lot more contribution margin in relationship to your fixed costs, or your fixed costs are lower. But it's a kind of a way to look at, and that's why I said it's kind of a way of looking at your fixed costs versus your variable costs, because contribution margin is kind of a measure of your variable costs. The higher means typically that you have either high fixed costs or you're barely covering your fixed costs. But we can use this. One of the interesting things that we can use this for is, given a certain level, we can say from this point going up or down, how much will our operating income change? So if it says, if the volume increases by 6%, sales volume, how many more tickets do we sell? And our operating leverage is 8, the income would change 48%, just a straight multiplication. And that might seem like a lot, but remember, if sales goes up, our contribution margin is going to go up by a very a similar amount, and the fixed costs do not change. So for this particular, remember the operating leverage is for this particular target level. We can say from here going up or down, what would happen. And consequently, if the volume went down by 6%, that would be a negative change too. Okay, so that's the basics of operating leverage. So let's take a look at a little bit more long-form question that kind of uses a bunch of the different things together. Okay, so here we've got, it's some sort of state fair, and we've got a bunch of different numbers. Well, first thing we need to do is we need to actually break them out into fixed and variable costs. In fact, that's what the first part of the question does. It asks you, can you go through and identify? Well, concession fees. Concession fees are a percentage of food sales, right? Well, remember our definition of a variable cost is something that changes with the level of production. Well, here the level of production is food sales. So this would be a variable cost. And then a fixed cost is one that does not change with, in this case, food sales. So does the electrical service change? Well, the actual usage might change, but the fee does not change. So here we would see, okay, that stays the same. Employee wages. For employees with total 12-day wages of 95.6. Well, it doesn't look like it changes by how much food they sell, which I don't know, is that good or bad? Fair admission fees. Okay, well, that's $50 per day. So this is fixed. And you can go through the whole list. And in fact, we come out that all of them are fixed except for the concession fees. So it says project, what are the projected total fees? So let's go ahead and figure them out. So this concession fee, well, we already looked at it. It's 15%, right? 15% of what? Well, of food sales. Well, what are our food sales? Our food sales are projected to be $4,000. And for how many days? This fair is going on for 12 days. So that would come out to $7,200. Our fixed fees, well, we've got the ground service fee. So this thing is $10 per, it says linear foot, but I think they really mean square foot. And we have a 15-foot by 12-foot stand. So it's going to be $10 times this 15 feet times 12 feet. And that comes out to $1,800. Parking fees, well, it's $50 per permit, but remember we have 4 employees. So the parking fees are going to be $50 times 4, so that's going to be $200. The electrical service, it looks like this is just a straight fee. There doesn't look like it's per person or any sort of thing. So this one, it looks like it's just, what is it, $290? And I just call that was a given. We didn't have to make any calculation on that. And the last one is this fair admission fee. Once again, $50 here for the fair pass. Now, I don't have it listed here, but in the text, I think it actually says if we're renting a stand, we get one pass free. So even though we have 4 employees, one of those is free. So I would say it's 3 times 50, and there's one that's free. So that'd be 150. So our total fixed fee is going to be $24.40, and our total fees are going to be $96.40. So a little bit, I guess, have to make sure you pay attention to all the details there. So moving on to the rest of this, well, we're going to look at the break even. We're going to look at, first of all, we're going to look at break even, then margin of safety. So break even, what is the break even sales if the variable costs are 60%? So this, I have said it once or twice, and I think it's worth reminding ourselves. Remember that sales is 100%, is the 100% number. And then you have minus variable costs equals contribution margin. So whatever these two numbers are, they make up sales. So whatever, for example, here it says variable costs are 60%. Well, it really doesn't like little things. Whatever this number is, the other number has to make it up to 100%, because the two combined equal 100%. So notice here they don't give us contribution margin percentage, they give us the variable cost percentage. So here we would say this is 40%. And sometimes in these problems you just have to look at the problem, they actually want the decimal number. So what is the break-even sales? Well, let's see. We're going to have to figure that out by taking our fixed expenses, and here the operating income is 0 because we're looking at it as a break-even. If we were looking at it as a target profit, this is where the target profit would be. So how do we get our fixed expenses? Well, we figured out our fixed fees, right? So here is our fixed fees. So we have one of the numbers. Do we have any other fixed expenses? Well, we do, and we're going to go back up and look at the list. and it's this number right here. This is our wages. And remember, we decided it was fixed. Remember, we said here the wages were fixed because it was just a total of 9,560, and it didn't matter how much we sold. We were paying that much whether we had sold a lot or a little, and that's the definition of a fixed. So we have the fixed fees and we have the fixed wages, 9,560, and that comes out to exactly 12,000 there. So divided by the 40%, that gives our break-even sales. We need to sell 30,000 to not lose any money, but also not make any money. What is the margin of safety in dollars and percentage? Okay, so we said that if this was our break-even, so that we can put that down here, right? This is our break-even dollars. And we said our margin of safety is what is our buffer for our target sales. Well, do we have a target for our sales? Well, we do. We said we were planning on selling 4,000 a day for 12 days. And we can figure that out here. So that was what, 4,000 a day times 12 days. Well, that's our expected sales then is 48,000. So we can see our buffer, at least in dollars, is going to be $18,000. And if we wanted to figure out the ratio, we would take this same number, 18,000, and divide by the expected sales, 48,000. And our ratio there is, it's not quite, okay, it's 37.5%. Okay. So where do these marks come from? I go through and check it before we start. So I think somehow it's getting added as we. So now we come down to question 15, which is going to do much of the same things that we did before. A lot of times it just depends on what's the information given, what information is missing, and we've got to just take what we've learned to be able to figure it out. Just on that one page. All right. Okay. So again, we have another scenario, and we're given some real basic information. We have target income, we have variable expenses, and we have fixed expenses. Okay. So first thing off is, what is the margin safety in dollars? Well, you notice to get to the margin safety of dollars, I guess maybe let's look at this is the thing for margin safety in dollars. And what you need is break even sales and target dollars. Well, we don't have either of those numbers. So the first thing we're going to do is, well, let's first figure out what is our break even dollar amount. And our break even dollar amount, first we're going to need to know what's the contribution margin ratio. Now, just like I said before in the last problem, sales is 100% minus variable cost equals contribution margin. So we're given 40% here. That means our contribution margin is going to be 60%. So here, we just have to make sure that we recognize the difference between the variable cost percentage and the contribution. So 60%. Now, how do we go about, well, we've got our fixed expenses, right? 7,500, that is given to us. Oops, one extra. And we are given a target operating income. We want 30,000 there, right? Oh, I'm sorry. We are going to use that. We're going to use that here. When we're figuring out our break-even sales has 0 operating income. So we're just trying to figure out the break-even sales. So when we figure this out, 7,500 divided by 60% equals 12,500. So that is our break-even sales. And now we want to figure out, well, what is our target sales? So this is the target operating income, but remember, operating income is after you've covered fixed expenses and variable costs. So we know what our fixed expenses are, and we know what we want our operating income to be, And we're going to use this ratio because this ratio helps us explain how much contribution margin is in there. And when we add this up, so that would be 37,500 divided by 60%. That ends up being 62,500. And that is our target sales. When we subtract that out, our margin of safety, how much money, how much sales we cannot hit. So you can see this is quite a good buffer. If your target sales is 62,000, but you only have to make 12,000 to break even, that's actually a pretty good business. I don't think you'd actually see that number very often. Okay, so what is the margin of safety as a percentage of targeted sales? Well, we've got these numbers here. So the margin of safety dollars is 50,000. The expected sales is 62.5. And that would bring our, so you see this is a great percentage, exactly what I was telling you before. The margin of safety is such a big part of our target sales that, you know, all of what we're saying is the margin of safety is the gravy, right? So we have a lot of gravy in this thing. So now we come back and we're going to add in the operating leverage part of it. Okay, so the operating leverage, remember, we get to the operating leverage by taking the total contribution margin dividing by the operating income. Except we don't have the total contribution margin here yet. So what we do is we have the total sales and we have the contribution margin ratio. We're saying for every dollar of sales, remember, coming back up here, we're saying for every dollar of sales, 40 cents is variable cost and 60 cents is contribution margin, right? So if we say, well, if our total sales is 62,500, for every dollar of that sales, 60 cents is contribution margin, and we just multiply that out. So our total contribution margin here is 37,500, and our operating income, I think, was 30,000. Yep. Our target operating income was 30,000. And that comes to 1.25. So you notice here in the previous one, we had an operating leverage of 8, where our contribution margin was barely covering our fixed costs, and we had a low operating income. Here, our contribution margin is completely covering our fixed costs and making it very easy for us to earn a profit. So our operating leverage is a lot lower here. So by what percentage will the operating income fall if sales volume goes down by 12%? Well, we can use, once again, this operating leverage we can use it in this fashion. We can use it as volume change to figure out. And so that would be 15%. So it's a smaller percentage, but that's because we have such a big cushion of contribution margin that changing the sales a little bit here and there isn't going to change it by much. Whereas the other one, where we had so little extra income, or so little extra operating income, that, you know, if we increase the contribution margin a little bit more, it would have big benefit. So don't think of this as being bad. It just means that we already have a whole lot of margin. We already have a whole lot of profit, operating income built into our model, so that volume change isn't gonna have a huge effect, at least from a percentage wise. Okay, that's the did not go through number 17, but once again, it's a combination of all of these same similar questions: margin of safety and operating leverage. If you have any questions, please email me or visit me on our normal Zoom office hours. Okay, thank you.